GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Janet Yellen says she wants to be around for another term as head of the U.S. Fed, and they've decided to do nothing, although does it look like they're going to raise interest rates again on the U.S.?
In September is apparently the latest guesstimate that seems to be on track with the verbiage they're using in their statement released today, and they've moved up the expectation for normalizing their balance sheet, which means, letting bonds mature and run off so that they're sucking up less bonds and putting less cash into the financial system. And they're supposed to start reducing that by $10 billion a month and then increasing quarterly to $50 billion as they go forward from here. But everything is always dependent on how much the equity markets in particular and the corporate credit markets, how much they react to in a negative way, and whether or not the economy seems to take another leg down. They're always dealing with the most fragile, recovery ever in human history, and we've seen this many times where they've tried to head for the exits in this emergency policy that they implemented originally starting in 2009, and every time they've threatened to head for the exits or made some minor move, you've seen stock and corporate debt markets have a nervous breakdown, and they come running back to try and calm things down with, more speeches and more endless verbiage. And really, it's just a hell of a mess. They've painted themselves into a corner by being way too lax for far too long, by being responsive primarily to financial markets rather than to the better good of the economic health of the country. And that has been something that's gone on really for 30 years. It's just that, the more the more extreme they got in their policies in the past few years, that begat even more extreme policies and really just an addiction. The world moved from, a recognition for many, many decades that saving and rewarding savers and, compensating savings correctly by, the world's companies sell bonds to savers to raise money for investment, and banks borrow savings to lend to other people. So savers have always been seen as the great, blood that runs through the economy. And yet, over the past 30 years, as rates fell, as the political will, corporations, no one wanted to see a downturn in demand. No one wanted to see that retrenchment phase where the consumer pulled back and rebuilt their stores, built up their savings rates. And so because of that, every time there was a lull or a pullback or a minor recession, monetary elixir was released and credit became the new, rallying cry. So the world shifted to a belief that credit was the lifeblood of the world economy. Well, now we've got the most indebted world economy that ever existed by many, many multiples. And we have an aging demographic, and, even with flat wages, the problem is that unless rates can go lower, and they're already at the bottom of any rational expectation, then you really can't continue to service more debt at this point. And so that makes it just the more they try and force more debt here, the more lethargic, the lower the growth, the less cash flow everyone has to spend. again, the Fed today was talking about, missing their 2% target. Well, they've, in terms of inflation, they've missed this 2% target for more than 7 years now. They aren't going to attain it in this particular cycle. So that means that, 5 years since Mario Draghi said he'd do whatever it takes, they've certainly done more than anyone thought would be even rationally contemplated, and yet they haven't hit their targets in terms of inflation and growth. So it's very interesting. We'll see, the fraying that's coming apart in the political system in the U.S. right now is quite spectacular. It's like watching a gong show every night. Whether or not Mr. Trump is going to reappoint Janet Yellen in 2018, or indeed, fly in his apparent pick, which is Gary Cohn, former head of Goldman Sachs, I don't think you're going to see any change in this preoccupation with monetary policy as the elixir or the magic sauce. Because in a world that's already got too much debt, we've gone so far past, responsible financial management that everyone's now begging for more crack as a way to keep the thing going. But I think that we've really hit the end of this road, and I think that the Fed does feel it needs to unwind to have some semblance of respect or any kind of credence for what it's been saying all these past few years. And so it is tightening, right? And tightening has ignited the economic downturn in every case since all but one since the Second World War. So this tightening, even if it's very tiny and modest, is likely to precipitate the next leg down in the economy. And then the problem is, of course, as we've seen in many of the last recessions, when you have an economy as levered, as dependent on asset bubbles as the current one is, then you don't just get a kind of a moderate downturn or recession, run-of-the-mill 9 months, 20% down and then back up. You tend to get an extended, prolonged contraction that wipes out much of the gains that were seen in the asset run-up prior to that, and then reveals all the debts that remain. The assets recede, the debts remain, and everyone realizes they've been sold a bill of goods again.
We'll have more with Danielle Park right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Sign of the times, perhaps. Petronas has canceled their $11 billion project in BC, citing market conditions. Other people are saying Canada's regulatory regime is so arduous and takes so long that a lot of companies now are giving up on doing business in Canada, period, because they just hate these long extended periods of not knowing what's going to happen.
Mm-hmm. I don't really think that. I think that's not really the reason that they're having so much uncertainty. I think that the reason there's so much uncertainty right now in the oil and gas space is that the prolonged decline in prices that has now persisted again since 2015 is, just as that downturn hit, a huge wave of technological innovation and ability, infrastructure, everything came online in terms of greater efficiency, more biodiverse fuels, and also the advent of the electric car. And all of these things together, if you look at the projections for, the use of fossil fuels going forward, it is literally changing and reducing month over month at the moment because of there's all these moving parts. Like if you look at the IEA, I was just looking at a recent report, and they're suggesting that EVs alone, which are being widely adopted, the electric vehicles that are, it's gone way past people, the naysayers saying that was a fantasy, to every major car manufacturer in the world pledging to catch up quickly and, shifting to electric production. They're expecting that that in itself, plus the efficiency gains that are being made in all sorts of appliances and machinery every day. Just think LED bulbs, just think, timers, everything that's being implemented to make the world need less energy. All that is hitting at the same time as, we've already got this decline in oil, and we've got this technological increase in capacity and production and inventory worldwide. So the Saudis are racing to try and get their Aramco deal, sold to the public to raise some funds. Why? Because they want to divest themselves of some of their fossil fuel concentration in order to invest in alternative energies. So this is something that's at a galloping speed. And the rate of adoption is like an S-curve, as we've seen in, other major innovations in the past few years. It used to be that you would get to 80% saturation from, once you had 1% adoption of a new technology, you would get to 80%, sort of penetration of the marketplace within 20 to 30 years. But in the past few innovations, whether it be tablet computers or cell phones, that revolutionized the world and the way we interact and the way we do business, those things are going much faster than those rates of acceleration that we saw in previous technologies. So that, I think, is what's the great undermining factor here. You've got just the speed of change and, battery capacity. Everything is just kicking into high gear day over day. And ironically, this is all connected to our computing ability, right? The speed at which we are now getting technological advance has a direct connection to the speed at which our computer ability is accelerating. And so all those things are connected. So I think that's why these old school sort of business models are really being knocked on their ear and saying, geez, and these are long-term investment cycles, right? For them to bring on a natural gas pipeline, for them to, invest in all the infrastructure required for some of these projects, it takes a long life cycle and a huge upfront capital investment. And of course, they're looking at it saying, gee, as much as we want to continue as usual, does that make sense? Is the rate of return going to justify that kind of expenditure? And you've also got a population of investors which have become extraordinarily short-term focused. You've got activist people taking over the boards of public companies insisting on quick results. They want cash flow return to investors. So all this immediacy is really in direct conflict with the long-term investment needed for some of this, these traditional businesses at a time when you've got all this rapid change all around them. So they can blame they can say Canada's taking too long to approve things, but in many cases I think they're actually going to thank the fact that it took longer to approve something, because 2 or 3 years from now, it may prove to be something that is a complete wash in terms of they should never have made the investment, it's a bad business plan, things are changing too quickly.
Should they use that natural gas to make electricity for the new e-cars?
Well, there's, a part of the IEA's expectation which says that we could have a $5 million barrel a day decline in the demand for global oil could happen within the next 20 years. And part of that is based on an assumption of some fuel switching. So you've definitely got some, people on the edges of the fossil fuel industry who are saying, I know, let's just go to using different kinds of fuel. But I don't actually think that, and they may indeed do that, but I think that's a short-term kind of response. And again, once you have to make such big investment up front, you have to look further than, is this going to tide us over, is this going to seem more clean and efficient for a little bit, but is it long-term going to be the direction that the demand is going? And I think longer term, it's not the direction demand is going. So everyone's going to have to figure out their own business model, and some companies, may be producing natural gas, and just have some sort of store available, and maybe on a short-term basis it makes sense to produce more of that. But I do think that in the longer run, it's not going to be the product of choice. And once we have this, the battery capacity that's one of the areas where things are leaping so quickly. Solid state batteries, all these things are coming which are really upending people's understanding of where we're even at. And so it's such a fascinating time to be alive. I read probably on these new innovations and, do whatever tours I can of facilities and everything, to be up to date, but literally it's changing week by week. And I think it's a very difficult time for someone to be in the business space of fossil fuel production or even transmission or, like look at the car makers. I just, Mercedes announced yesterday that they're bowing out of the the gasoline powered, racing because it's clearly, there's only BMW left and they're now going to the Formula E. And that's by 2019. If you'd have asked, 2 years ago whether you were going to see an exodus of these, from this area of formula racing to Formula Electric racing, people would have laughed. But that's what's happening. So again, it's got a half-life here that's really taking everyone off guard, I think.
We'll have more with Danielle Park right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Danielle Park. Danielle, I've noticed, and other people now are also noticing, the Canadian dollar seems to be disconnecting from the petrochemical industry, where before you could clearly chart the value of the Canadian dollar to the value of oil. Oil hasn't moved very much at all lately, but the Canadian dollar is going up. Does that mean that the world is recognizing Canada is more than just oil and gas?
I wish it was that, but I don't think it is. I think it's purely been trading. I think that, if you look at a long-term chart of the U.S. dollar CAD, for example, which again is our largest trading partner, is kind of how we're measured in the world. We're right at that long-term trend that's been in play from the lows in 2013 of the U.S. dollar, where it was appreciating really kind of relentlessly over the last 3 or 4 years. There's been some major pullbacks in there. We're right back around 124 and high 124s to 125 in the U.S. CAD is kind of where that support is held since the oil breakdown in 2015. So we'll see. We seem to be, we have had an appreciation in oil again in this last month, and we've seen the Canadian dollar rally as against the U.S. dollar. I really think it's a trade that is being implemented primarily by computers, believe it or not so much by any kind of, human investment thesis or economic assessment. It goes on headlines. I think that there was this huge run-up in the U.S. dollar after November, which was irrational in my view, because there was an expectation that the Trump administration was going to ride to the rescue and change everything overnight. And, of course, that's proved to be a horror show. So I think there's been, again, the trade was long dollar on the election surprise, and since then it's come right back off again. Now we're sort of just testing to see, again, what is the engine of the Canadian economy today? It is housing and construction. So because of the oil prices have not rebounded, if you look at the IMF report that came out this week, it basically says, hey, we think Canada's going to, do better than some countries in terms of growth, but that's in a very weak field. And if you look at their projection for, next year, so 2017, they think that we're going to be slightly stronger than many countries, but if they look into the next year, they think that we're weaker again. And again, you've got all the world sounding alarm bells. Anyone that's following the Canadian housing story, sounding alarm bells on the debt levels, the unsustainable, increase, the housing starts, everything that has really been the engine of our economic growth. So if oil's not rebounding in a meaningful way, and if capex or long-term investment is not continuing in some major projects because the oil story has continued to be weak and demand continues to be very questionable and cloudy and look negative into the future, then you have, what is the piston firing in the Canadian economy? And now you do have a preoccupation with exports, or a hope that we could have exports, but, again, with the Canadian dollar strengthening in the last little while, that's really not being very helpful to that thesis. So I think we've got a lot of concerns here about where our growth's coming, and the IMF, although they're sort of more optimistic in the next couple of months, is sort of looking into the 18 saying, oops, I think it's going to slow again. Really, the whole world is slowing, and a lot of the trading that you're seeing with the currencies, as I say, has become this very short-term preoccupation based on gaming and, what's going to happen in the next week or month, and whether central banks are going to speak. Because you think about it, central bank talk is vapid and repugnant in content, but the fact of it is that it triggers these headlines that the algos grab and run with. So you've got computerized trading grabbing headlines every time a central banker comes out to speak. That's really driving currency more than anything else in the world right now. Everybody's, got major debt problems, slowing growth, and central banks sort of running amok. And a lot of political uncertainty, which is instability, not uncertainty. It's always uncertain, but instability, because you have this great inequality of income and resources, which has largely come directly from the central bank policy. So it's been a very destabilizing influence. And again, back to the old days when people had some savings, they had some self-insurance, they had something built up, they maybe had a roof paid for over their heads. Today, very few people have that. Most people have, very questionable, if any, pensions through their employment. Most of the pensions are dramatically underfunded and starting to cut benefits. I mean, we've just been through 30 years of financial hell, if you look at it that way. Ironically, the appearance has been that we've all got wealthier, but in reality, when you check, you see that there's so much debt supporting the asset gains, the incomes have stagnated, and debt levels have risen. So I think it's a hollowing out period that we've really had. And so, I look forward to going back to what's going to actually increase the cash flow in the economy in terms of spending less and saving more. I think the green energy revolution is a huge part of that. It's going to lower expenses. It's going to offer good growth and new jobs. I think those kind of things are where the investment dollars are going. And then there's a lot of trading noise going on around everything else. But, the corporations have been primarily the main buyer of shares in the past few years. That's all kind of financial gimmicks. That's not anything to do with long-term vision or planning or investment. And I think that that's because the landscape is changing so dramatically here. And many of the status quo players are running the biggest companies are really working with dinosaur ideas. And the startups and the innovation is coming from the smaller companies, which are, coming from literally nowhere to upend entire industries in a matter of 3 and 4 and 5 years. And you're seeing that all over the place, whether that's in the food production space, a lot of small startup companies are transforming, urban farming concepts, vertical farming, hydroponics, everything that's coming from the liberalization of marijuana. Ironically, I think they've far overestimated the appetite or interest in marijuana, but the knockoff effect, I think, is that it's really helping to bring along the farming, the alternative farming models, so that, again, we're going to get benefactor food production, local food production, healthier food production out of some of this stuff. And that's all positive too. So I look at, let's get back to basics, away from headlines and central bank nonsense and trader algorithms running off of headlines. What's really going to matter? Well, building up savings again in the economy, building up health again in the economy. That means we can't afford all this ill health promoted by bad food. We have to revolutionize the food system in the Western world, which we are able to do, again, through this confluence of vision from startups and also technological ability. And the need to lower costs, which includes lowering sick care costs and increasing health. The need to increase savings means we have to spend less. We have to cut out more middlemen. We have to cut out financing charges. And we have to lower the cost of shelter. So I think all that, the way we're going to get lower shelter is through correction in prices, which has come from these asset bubbles. So it's really kind of all connected. And ultimately, I think all we need is a gradual erosion of economic demand, which has continued no matter what the central banks do, and the next, bear market in asset prices is going to restore affordability again. But first, unfortunately, it's going to also hit the people that are currently holding those assets, because the valuations are very unattractive, and the ones that are unaware of that or thinking they're going to just buy and hold and continue to collect the dividend, unfortunately, many of them won't be able to, because they are too over-levered today and they're not prepared for the price declines that could come. So I think, it's just, again, trying to not get distracted by noise, focusing on the things that matter, thinking about how to get your fiscal health in order on a household, on a business basis, and then that will be the engine of the economy.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
Enjoy your birthday.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for our guests or for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.